Well, if you do, that's unfortunate, but luckily, Archith's next talk will have you rolling in both dough and love as he gives you a guide on how to forge healthy relationships in the stock market. Next up, please give a warm welcome to Archith Sharma.
According to a study by the health insurer Cigna, 3 in 5 Americans are lonely. This same study reports that the number grew 18% between 2018 and 2020. The pandemic has only made this worse. Now more than ever, in a digital and post-COVID age, we need to maximize the value of our relationships. Cultivating the right connections is critical for our collective mental health. I am here for 2 reasons. 1, to share with you a unique source of relationship advice, and 2, so I can say thank you for coming to my TED Talk when I wrap this up. But let's focus on the first reason for now. You might be thinking, what makes this source of relationship advice more valuable than my therapist? Or, wait, why is a 16-year-old giving me relationship advice? But what I've learned is that the principles for successful investing in the stock market are very similar to the principles used for cultivating happy relationships. Let me explain. I've taken the liberty of creating a financial universe for relationships. First up, currency. While the stock market trades in dollars, the relationship market will trade in happiness. This should make sense. You invest dollars to have more dollars than you do now, and you invest happiness to be happier than you are now. Next, let's answer the question, why should I invest? To all the introverts in the room, if you don't invest, you're holding cash. And holding cash is right about the worst financial decision you could make. This is because of inflation. Happiness today will be worth less tomorrow, just like dollars today will be worth less tomorrow. So, to protect against this, we need to invest in assets, whether it be stocks for dollars or relationships for happiness. Robert Kiyosaki writes in Rich Dad Poor Dad that this is the way to make sure that money works for you and does not get eaten up by inflation. However, this leaves us with one large question. How do we invest? And how do we create the principles from successful investing to successful relationships? Well, there are 3 things that investors in the stock market do that you can transfer to your relationships. They look to the long term, they diversify, and they make sure to do due diligence and know what they're investing in. The first tip from successful investors is to look to the long term. Warren Buffett says that his favorite holding period for any stock is forever. Jeremy Siegel, Wharton professor, writes in his book Stocks for the Long Run that over the last 200 years, stocks have averaged a return of about 7%. There are 2 things that make this chart on the left interesting. The fact that cash lost 96% of its value in the same span, and this chart on the right. This chart from NYU Stern shows variability in the returns in the S&P 500. If you invest for a long enough period of time, returns will come back to Siegel's mean of about 7%. This is what I like to call the Jeremy Lin principle. Jeremy Lin is a basketball player who for 2 weeks was the best on the planet. He outdueled Kobe Bryant, he hit game winners, and Time magazine dubbed him Rinsanity. However, 2 weeks later, Jeremy Lin went back to being regular old Jeremy Lin again. Jeremy Lin's example tells us that there will be outliers, but given time, you will come back to a set mean, which is great if you're a long-term investor. Now, over 25 years, your relationships are going to revert to the mean, and this should also make sense. See, the longer you know someone, you're bound to have some ups and downs, but eventually, your returns are going to stabilize as you understand the other person. And the best part about investing for 25 years is that your returns are going to compound. Why invest 1 year and get 50% when I can invest 25 years at a 6% return and 5x my investment? This is why whenever you're investing in relationships, always remember the SEGO principle, relationships for the long run. The next thing that pretty much all successful investors have in common is that they diversify. And this means having multiple equities in the terms of stocks. Now, if I put all my dollars into one stock, and then say the founder is going to be accused of fraud and the entire company goes bankrupt, then I just lost all my money. So to protect against something like this happening, investors who put their money across many different sectors and many different stocks. This strategy is very important to us, as this means that we shouldn't just invest into one relationship, we should invest into different types of relationships. Now, investors invest in sectors such as utilities, technology, financials. And for relationships, we also have sectors. You have the relationship with your family, you have the relationships with your friends, and I can keep going on. There's another very powerful tool for relationship diversification, and that's going to be funds. ETFs and mutual funds are a vehicle in the stock market that allow multiple investors to pool money and then invest. Now, in our case, a fund is like a group of friends. If you have a group of friends, you pool all your happiness together and you invest in each other. This connection between all of your happiness helps friend groups create such a strong bond with each other. And it's why people stay close to their school or college friend even after 30 to 40 years. They have given them the best returns and they have given them safe returns as well. So whenever you're constructing your portfolio of relationships, always make sure to diversify and have multiple relationships. The last and probably the most important thing that successful investors do is evaluate investments and do due diligence on them. For stocks, this is a two-pronged process. You have quantitative analysis and you have qualitative analysis. Just one problem with this. People don't release 10K statements showing everything they did in the last quarter. If they did, that would be kind of creepy. But we can create an analogy for metrics that companies report into the relationship universe. There are three things that BlackRock believes are quality metrics for investing: return on equity, debt to equity, and variability in earnings. These metrics may sound complicated right now, but really, they can be explained in one word right here. Return on equity is a measure of a company's efficiency. Basically, it answers the question, how well can a company turn a dollar invested into a dollar of profit? For relationships, this means how much effort do you need to put in to get happiness value out of it. The next thing is debt to equity, and this is a measure of company risk. The higher a debt to equity ratio is, the more a company needs a lot of financing to create minimal value. For us, this means if you need to make a lot of sacrifices and you're not getting a lot of happiness from it, then your relationship has a high debt to equity and may be at risk of not continuing in the future. The last metric that BlackRock looks at is earnings variability, which is just a measure of how consistent a company is. How much can you trust this company? For relationships, while a predictable relationship may seem boring, they're definitely the ones that are going to last the longest. Consistent companies with a long track record will always produce the best investments in the long term, and a relationship which makes sure to utilize this principle and be built on trust will also last towards the long term. Now, the most interesting part about this chart is column 3, because not only is it a recipe for how to pick relationships, it's also a chart that you can look at to improve yourself. Take a good look at these metrics and make sure that you understand them. Everyone else in the room is also an investor. So what makes you a good investment for their relationships? Well, to answer this question, I pulled from venture capital, which is where new companies get funding. And the answer was pretty simple. Score well in these metrics for yourself, and people will invest in you. So be sure to create value for others through service. Then make sure to sacrifice for them and be there for them. And make sure that you're someone that people can trust. Doing these three things will make people want to invest in you. And when people invest in you, don't forget that not only are you an investor, you're also a company that's making money. So whenever people's investments come into you, make sure it pays dividends for them. The only thing that means is that you Incorporated has gone up in value. Now, as I kept diving into this rabbit hole, I found even more similarities. People keep positioned in bad investments for the same reason they keep saying, I can fix them, after 3, 5, even 10 years of a toxic relationship. Now, what do the good investors do whenever an investment isn't working out? Well, it's pretty simple. Peter Lynch, legendary value investor, says it's time to cut the weeds if an investment is not working out. If after a fair shot, you don't see a good return on happiness in your investments, it may be time to hit the sell button on a relationship. But if you make sure to evaluate potential investments properly and use the metrics to your advantage, you're probably not going to have to do that. Warren Buffett says, make sure to only invest in things that you understand. So only invest in the relationships you understand, and make sure you understand why you're investing in it. If you can answer these 2 questions well, then there should be no need to hit sell. Well, we're just about to the end of our journey through the similarities between relationships and the stock market. Before I challenge you to get out there and apply it, I want to recap. First, make sure to look to the long term and make sure to invest. Second, make sure to diversify, have multiple relationships, and connect with others. And lastly, make sure to evaluate, do due diligence on potential relationships, and also make sure to build yourself up in the metrics. Make yourself a good investment as well. If you do all of these things, then the possibilities for your happiness are limitless. Now, I challenge you to get out there and bring down this number. Cigna's statistics should not be as high as it is today. And if you apply these principles correctly, we should be able to bring this down to 2 in 5, 1 in 5, and eventually to 0. Now, as I said earlier, I come here to share this unique source of relationship advice, and so I can say thank you for coming to my TED Talk when I finish. So, thank you for coming to my TED Talk.